We have with us Kamini Shah, CFO of Birlasoft, now joining in. Hi Kamini, good morning. Thanks for taking the time out to talk to us. Kamini, let's start with revenues. Revenues have grown about 2.6% Q on Q, largely on back of ramp up in previously delayed projects. As we look ahead into the second half of the year, how confident are you of sustaining this sort of momentum, especially considering that Q3 usually has seasonal headwinds? What are your thoughts?
So absolutely, Sanjana, like you mentioned that I think this quarter has been good or a rebound from a revenue standpoint. The good fact is it is across all verticals. You know, where you see the growth, it's in our manufacturing sector. If you see it in our utilities sector, you see it in BFSI. So we are quite pleased from a revenue standpoint that we are back on track as far as that is concerned. Q3 is normally a seasonally weak quarter because of furloughs, and I think we do expect it. Furloughs in the current indication seems more or less in line with what was there last year. So I think Q3 will be a little soft from that standpoint. And I think from Q4 onwards, we are expecting that with the US elections out of the way, companies will start becoming a lot more confident, and hopefully we should start seeing a lot more momentum from Q4 onwards.
Okay, Kamini, would it be fair for us to ask you what are you quantifying internally as a goalpost in terms of run rate for revenues in Q4?
See, we don't give a specific guidance at this point of time, but suffice to say that our pipeline is looking very good at this point of time. So, which I think is giving us the confidence to say that we need to see the conversion of the pipeline into strong deals. And I think once we start moving into that direction, things should start looking a little better.
Deal win TCV was down 19.3% year on year on a TTM basis. And new deal wins are also lower than what we've seen in the previous quarters. How are you addressing the slow pace in decision making from clients? Are you changing your strategy? Because I do believe that the focus now is on top line as opposed to bottom line. Where do things stand? And again, is the improvement going to be fourth quarter?
So see, if you really look at, like I just mentioned earlier, our pipeline is looking better. A reason why our deal wins are a little soft, and I must admit that, we are not happy with our performance as far as deal wins are concerned. But a lot of our wins have actually, been, the paperwork had not been completed. So we do typically expect that Q3, Q4 of the year would probably be a better quarter from a deal win standpoint. If you look at from a proportion standpoint, actually our new wins are much better comparatively as a part of it, because we've got about 89 million of new wins that we had out of our 136 that we have declared for this quarter standpoint. So that gives us a confidence that I think as if you continue on this momentum and if you really get things working well for Q3, Q4, then I think we should not have a concern from that standpoint. I also wanted to call out one change, right? See, we are definitely focused on profitable growth, and I'll address that to that extent. The reason we focus a lot more on consolidation deals as far as the current quarter is concerned is because it gives you a higher share of the wallet. And on top of that wallet share, you have an opportunity to play a lot more in the digital and transformation space. So definitely, we do not want our margins to operate at the level that you've seen in Q2. We as a management team are very focused to make sure that our margins start moving up in an upward direction. And we do expect that starting Q4 onwards, right? Because Q3 is is a seasonally weak quarter because of furlough, and we are giving a wage hike starting October 1st. So there would be an impact on margins as far as Q3 is concerned. But starting Q4 is when we will be focused on improving margins quarter on quarter.
And as a CFO, I think you're most concerned about that and cracking the whip at all times. But I want to spend a little more time on margins with you. There has been a very obvious contraction. And like you said, the focus is to increase wallet share and then, of course, bring in the pricing power when you are in a position to do so with your clients. But margins at 12.1%, there's also a higher on-site mix and upfront investments in vendor consolidation, like you indicated to us. As we look at the timeline and expectations, and I'm not saying this has to be next quarter because I do know that there'll be a further impact on wage hikes in Q3. When do you see yourself or the company returning back to the 15-16% margin range? Fourth quarter, is that realistic as well? So then we know in terms of what our expectations are, right?
While I would wish it to be in Q4, it would never happen in Q4. I think it will take us a couple of quarters, right? And I just also want to outline some of the things that we are doing, right? Because one is, of course, you've picked up our on-site ratios definitely higher. We're looking at, how as we consolidate and mature in some of these deals, we should be able to move our ratios more towards offshore. I think that's a very key lever. Our utilization is lower than what it used to be in the past. So that's going to be our priority area, our pyramid. Are we looking at also G&A? I think we're doing multiple things on various fronts at this point of time to get our margins back on track. But if I have to be very realistic, I think it will at least take us about 3 or 4 quarters before we get to that stage of 15, 16% that we were there right now. So I think we will continue working on it, but making sure that our revenue growth is in line with what we are aspiring to. At the same point of time, the efforts on margin will continue. But realistically, I think it will take us a couple of quarters, at least 3 or 4 quarters before we get back to that trajectory of 15% that we spoke about.
Because at least then we know what we are focusing on in the next couple of quarters as investors. Project Optimus was an initiative that you mentioned, that the company mentioned for margin improvement. You want to talk to me about Project Optimus? What is this about? What sort of margin contribution are you expecting from it? And what will the revenue, what will be the contribution in terms of top line as well? Would be good to understand.
See, Project Optimus is actually our internal tech transformation program that we had embarked about 2 quarters back on this. Now, what it essentially intends to do is that we are really looking at simplifying our internal processes, digitizing the entire workflows to make it easier. In simple terms, I would say it makes it easier to work within Birlasoft. And the kind of insights that we are creating with this will also help us run our business a lot more effectively. So, it is actually in an agile mode. So, the modules have started coming out. We've started looking at areas and areas. We've seen some initial gains from Optimus standpoint, which you'll also see in a reduction in our sales and support headcount. I think that's really an initial indication. I think we are expecting at least it should be able to contribute at least about 50 to 100 basis point from a margin standpoint. And that will be one of our strong levers that we will be focused on in the next couple of quarters that would enable us to stage the margin recovery.
Kamini, digital and data and ERP services have grown 6.5% and 4.5% Q on Q. And infrastructure has seen a significant decline of about 19%. Are there plans to revive growth in the infrastructure services? And what role do you think digital and ERP will play? Because I do know that's a better margin business for you as well. So is it a conscious effort to sort of, change the product mix or the service mix?
See, we are definitely focused on infrastructure business. And the reason we are focused is because it is annuity business. And as we work with integrated services with our customer, it is important to have a footprint in all the areas, whether it's digital, ERP, and infrastructure. The reason you are seeing a significant gap between quarter on quarter is because in the last quarter, we had one significant services deal that we had worked with our customers. So that's the reason why you see the share of infrastructure business really lower compared to last quarter. But ERP and digital data, more specifically ERP was lower last quarter, is because some of our projects that were stalled, right, which is the reason why we had a lower revenue, have actually come back on track. So, I think our focus will definitely be on digital ERP. I think we are equally focused on all the three service lines because that will enable us to get a good balance of margin and annuity business.
Kamini, you talked about how the strategy of the organization is to focus on top line instead of bottom line, increase revenue and wallet share. And then, of course, once you're in a comfortable position with your client, you will start, of course, implementing better margin products in that sense. But I want to draw and get an understanding because while that is a strategy, that's not what's happened this quarter. Over 50% of the deals that you won are net new. How are you ensuring repeat business while wallet share will increase? Sure, but when you go back to renegotiating contracts with your clients, don't you think you may be on the receiving end on this one? Because at least this is what we've seen so far. So what is going to change in your opinion?
So see, if you really look at it, it's also, if you look at the whole TCV or the deal win process, there's a cycle in terms of how renewals happen, right? And in our business, a lot of our renewals typically happen in Q3 and Q4 of the year. So our initial indications to what we have seen, I don't think we are seeing a challenge as far as renewals are concerned, right? So, we are aggressively going behind market share as far as our clients are concerned. And we are also trying to work with them to make sure the renewals are taken in place. So from my standpoint, I'm seeing the two are very different key focus areas. that our sales organization is working on to make sure that we continue to retain our existing business. At the same point, we go aggressively behind in terms of increasing the wallet share. I think it will probably be a prolonged strategy in that sense to be able to grow.
Very quickly, America has shown, again, a strong growth, 6.7%, but there's quite a bit of uncertainty there. On one hand, you've got geopolitical stress, the other, you've got elections, which, of course, has seemed to be or will be an overhang for at least this in the next quarter. Life Sciences has seen a decline of 1.2%. What is the strategies improving life science and on geographies as well? What are the verticals you're sort of focusing on? And the reason I ask you this as well, because apart from the US, you've got about 50-odd countries going into elections this year.
No, you're absolutely right. So US will obviously be is our biggest market and will continue to be our focus. So if you really look at our focus verticals and the way they're doing right now, BFSI has done exceedingly well for us. In the last 1 year, we've grown almost at about 20%. So we will continue to focus on BFSI. It's a small business for us. Manufacturing has been a little bit slow, I think, from that standpoint, but we are confident on manufacturing given the investments that we are making in this area. See, life sciences, while we work with some of the real marquee global clients, I think we've seen it very soft for the last couple of quarters. Our expectation is that in the second half of the year, we expect the life sciences business to start to turn around and start showing growth in this area. So, this would be ANU, I think, would continue to operate at the current level of growth that we are seeing. But, these are the sectors that we would definitely bet on. Now, if I look at rest of the world, right, and we have made a very specific strategic investment because we also wanted to grow outside the US. As far as rest of the world is concerned, we are not focused on all countries. We are focused on UK, we are focused on Middle East, we are focused on some countries in Europe. So I think we are definitely making sure that we don't spread ourselves too far, but very focused on certain countries that will enable us also to grow from that standpoint. So I think it's a balanced approach that we are taking at this point of time. And that's what a lot of our investments are also going, which is also making a little bit of stress on our margins. But we believe that from a long-term standpoint, if you really want to think long-term, we should really look at continuing these investments. But as CFO, my role is to make sure that I drive returns and ROI out of the investments, which is really going to be our focus on very, very closely, strongly at this point of time.
Tough times to navigate, and you're running a tight ship. Thank you for that, Kamini. We'll hopefully see you soon, and good luck with the next quarter. Well, that's the management of Birlasoft. There's been a little bit of a change of strategy. The focus is to increase market share and revenue share from clients. So the idea is to increase wallet share, get into a little bit of a price discount, and eventually, once the comfort is built, it gives Birlasoft an opportunity to increase prices and renegotiate existing contracts. The fact remains that 50% of the deals that they've won in this quarter are net new deals. So the question still remains whether or not they have the ability to, of course, get repeat business from existing or new clients. Now, margins have been compromised. Next quarter will be tough. It follows and the fact that there will be wage hikes. So some more decline in pressure on margins than Q3 expected, but Q4 is expected to see them turn a corner in terms of bottom line. In about 3-4 quarters from now, the expectation is that margins should return back to 15 to 16%. Well, ambitious, but nevertheless something worth taking note of. The stock, though, under pressure this morning.